we felt like for X-Tau, it was an asset that we held in the form of Tau already in a big position in our fund. We saw a lot of different ways that we could earn yield with a portion of our Tau, but on a risk-adjusted basis, harvesting this NAV premium and doing it with folks we thought were really trusted operators ended up being, for us, the best use of our capital.
You buy assets for cents on a dollar in public markets, private equity type play, let's say biopharma companies, all of those, and then restructure it and the difference between the realized value versus what it's being traded at. And there's a $30 to $40 billion market opportunity out there in terms of trying to restructure those companies and unlock value. And when you're unlocking value, you can just convert it into Bitcoin or whatever asset.
I was hired out of the Discord, right? Because I was in there so much, writing blog posts, talking to the community, etc. And I wouldn't have been doing that unless I had more skin in the game than $2,000 or $10,000. So the cat's out of the bag, and it's difficult to do the ICOs because if you don't throttle it, you'll have VCs and all these people who come in and take all the ICO.
The question now is go-to-market and sales, really, like business development. The networks are built out, there's investor attention, there's tier one customers and partnerships that are kind of like lined up and have signed things, but it's just about scaling the kind of sales function for the industry, and I think also for specific DePINs. Welcome to the Building in Public podcast. Mehdi, I want to start off with a question for you, given that this is probably pretty meta for you. You're usually interviewing people, not being interviewed, but you were in the podcast at Animoca when you're on the ventures team there, and now you're kind of leading the effort on the podcast side and also investing at Hypersphere. So I'm curious what you like about podcasting personally, and then also how you see it fitting into a venture fund strategy.
Yeah, very good question. So I think podcasts, there are a couple of things. One main thing about podcasting is it kind of forces you to research, to know what's happening. So for example, if you're hosting a guest, you need to know your things inside out. So that forces you to research. And then once you're having conversation with people who are much smarter than you and are in the market pulse, it just helps you become smarter. So from an intellectual standpoint, you digest a lot of things and you learn a lot. And I think the second thing is, I think crypto in a way is also about attention and also about it's as much as it is a financial game, it's also a social game. So podcast allows you to just form a broader network and know a lot of people in a very scalable way. So it's not only the guests that you're hosting that you get to know, but people reach out. If you said something or if you asked a question and it resonated with someone, they reach out. So I think it's one way to kind of even scale your network and brand whilst you're sleeping.
For sure. And Sal, I want to put the same question back to you, actually, given that you've built this podcast with me for years now. Like, how has your thinking changed about like what you like about podcasting, how you see it fitting into a investing kind of venture fund or liquid fund strategy?
Yeah, I think the most powerful thing is giving people a platform when spaces are nascent. That there's like two strategies. You can go be a podcast for the biggest guests and try to accrue like a lot of brand value through having folks that already have an audience. For us, like when we first started, you obviously taken over and done a great job expanding the audience, but we were really focused on just getting the best DePIN founders on, no matter how early they were, no matter how unknown they were. And that was a big part of what gave us the conviction to like invest so heavily behind that space back in 2022 and 2023. So for us, it's been, it was an awesome way to just get deeper in the ecosystem, drive more deals, and just accelerate the growth of the broader space.
Yeah. And then Jack, maybe you're newer to the podcast game, but I know you guys just launched a podcast yourselves at Hypersphere. And I know you also met Mehdi, I think, when he interviewed you at Animoca. So yeah, curious what you think about kind of media efforts and the intersection of that and, venture liquid investing, and maybe why you decided to start a podcast at Hypersphere.
Yeah. I met Mehdi. One of the ways was through podcasting when he was at Animoca, and that was a lot of fun. And I think it's great to join to podcasts and share your thoughts on whatever the recent meta is. I think you can do podcasts that are kind of around weekly news or kind of day-to-day news, or you can do ones that are more evergreen and you're diving deep into a specific research topic or a specific business that could be watched 3-6 months later. Typically, I think a lot more podcasts are on the former side, so meaning they're day-to-day news. And I think what we're trying to do with ours when we launch it is is trying to provide some look into what will be interesting in, say, 1 month or 2 months' time. So similar to investing or making music or a lot of things, you're trying to guess what people will like in the future at some time frame in the future. So we're going to be trying to do that on like a 1 or 2 month time frame, or at least be relatively early to, if, for example, right now there's a huge awareness bump for these treasury accumulation vehicles. And so I think just talking about that early, so then when people want to get smart on it, they have maybe a podcast or two to look to that at least is the first level of information that you could get before you dive deeper.
Yeah, I mean, that's a great segue into what I wanted to talk about next, which is kind of, these MicroStrategy for X type deals. I mean, it sounds like you guys will have to have a founder or two of those on, just given how hot they are and how much people are talking about them. But I know you guys have invested in a couple of these deals yourself, including putting some pretty significant size into, I think the ticker is CEP, the Jack Mallers one. So I'm curious, maybe before we talk about specific deals, like, why do you think this trend is occurring now with kind of like the speed and size that it is?
I mean, the premise is simple, right? Like, what's the best exchange out there? Like after Binance, it's Nasdaq. So if you have the ability to have your assets listed on Nasdaq, that just opens up a capital market for you. And when you have the capital market open, a very simplistic way of understanding thematically is if the growth of a protocol, whether it's altcoin or Bitcoin, is higher than the cost of capital, you'll have compounding. So what these vehicles are doing, specifically with assets you like, what you can do is you can get a levered bet on that compounding effect. So if you like an asset that you want to hold long term, you can potentially take a bet on one of these vehicles that can take cheap capital from world's capital market, which seems to be Nasdaq and US stock market, and they can issue either equity or debt or convertible or different types of financial engineering to accumulate more of that asset. So the bet is, even though we call it these treasury play, but the bet is on the underlying asset that we are long-term bullish on and we think long-term can compound. And this just gives you a way to take a leverage position without getting liquidated. Like in crypto, if you take a per position, you'll get liquidated. In this case, you will be able to kind of do a present value of the future volatility. And for that reason, it kind of prompted us to start looking into them. And I think Jack can touch more on this, but I think there are ways to do these vehicles. I think one thing we are seeing in the market is market is attaching too much growth. Let's say if things are 3, 4, 5x premium, NAV to premium. So I think that is something what I think is a bit more questionable, not the fact that these vehicles exist. So I'll let Jack elaborate more on that. Like, we are very stringent in terms of our discipline that we invest in those vehicles that are very pretty close to NAV through pipe investments or through convertibles, but not be undisciplined and just do everything.
Yeah, there's a lot of different metrics that we look at when evaluating these. We've done, I think, 4 so far, right, Mehdi? 3 that have been announced that we'd be ready to talk about. But the overall idea of it and why, say, for example, why was Tether interested in contributing $2 billion in Bitcoin of their Bitcoin to CEP, and SoftBank donating $1 billion in Bitcoin to CEP. And for me, it really solves the yields problem or the yield opportunity. So what's better than holding the best performing asset over the past 10 years or 15 years? It's holding the best performing asset over the past 15 years while also getting yield on that asset in a lower risk way. And lower risk than what? So lower risk than, say, lending it out to BlockFi, Celsius, or Three Arrows, hoping for 7%. Lower risk than contributing in kind to a Bitcoin denominated share class in a hedge fund that is running quantitative strategies to accumulate more Bitcoin. And the reason why it's lower risk is the vehicle basically has ongoing costs, like an ETF has ongoing costs, and this business would have ongoing costs. So if it trades at below NAV, so if the value of its market cap is lower than the net asset value of its Bitcoin, then it doesn't do anything. Maybe it sells some Bitcoin to buy back some shares. But otherwise, I don't even think MicroStrategy did that during 2022, when was the longest period it traded at a discount to NAV. It traded at a 10-15% discount at points in the bear market for crypto. So the reason why it has less risk is than those other strategies on earning yield is there's no counterparty risk and there's less execution risks. So and there's no and within that there's no kind of custodial risk with a third party. So I think that's why Tether was so excited about setting up 21 Capital. And that was really the starting gun on what is now a 3-month, 4-month period where there's tons of these deals, not just for Bitcoin, but also for altcoins.
100%. We've at EV3, we've invested in one of these vehicles recently, and because I'm curious to get your guys. One of the things that came up in our IC discussion when we thought about investing in these is really just who the natural buyer for these vehicles are. It makes a lot of sense if you own Bitcoin or Tau today or whatever it is to go and contribute to starting one of these assets because the market is telling you there's a premium for it and you still have a lot of security to the underlying the token. But you are implicitly taking liquidity risk on, you can't redeem in kind. And so you need somebody to take you out of this trade at some point in the future. And there's a question of how many vehicles there are, how many total flows are there in, presumably traditional finance, people who aren't willing to buy things on chain. Or on crypto exchanges who will flow into these. So I'm curious how you guys think about just who are the natural buyers for these vehicles that eventually can give you some liquidity on public exchanges.
One of the interesting things about these vehicles is they bring in a non-directional buyer into, this is one of the great innovations of MicroStrategy, into crypto. So they sell these convertible notes wherein there's a forward price that is higher than the current spot price, where buyers of the note can convert into shares of the company, of MicroStrategy. And for that, they are paid some small coupon, and then they also have downside protection. So they can put the convert back to the company and get their money back. And it's collateralized. It's senior in the debt in the capital structure, and that it's collateralized by assets, whereas equity is not as senior in the capital structure, and those assets would be Bitcoin. So in the case of CEP, there's over a 2-to-1 collateral ratio. I think it might have even been 3 for those buying the converts. And these convert buyers, they're typically ARB funds, are buying the converts. And in the case of MicroStrategy, they're hedging out any of the Bitcoin risk by either shorting Bitcoin or shorting the equity, shorting the stock. And they're simply taking a bet on the credit spread or in the volatility of the stock. So, but that money that they're contributing to the company that's issuing the converts is still money used to buy Bitcoin. So they're kind of bringing in this non-directional buyer into crypto to provide liquidity, to provide capital to buy this Bitcoin. Then we can get into all the potential risks around it. But that's on the issuance side, that's one potential buyer. On the converts is these ARB funds and debt buyers. And then there's the directional folks who, like us, have a thesis on Bitcoin and think it's going to go up. So maybe we do the PIPE, we do the equity instead, or on the equity. And we look, as Mehdi alluded to, at a price close to NAV that we want to get in at, because then you have a little bit more cushion. You have a little bit more margin of safety. Some of these issuances are trading at 5-10 times NAV on the open market. That's obviously not where they're going to settle out at when the PIPE investors get liquidity. And but in the meantime, there's some retail excitement around it because they're low float, high FDV stocks essentially.
Yeah. So I'll just add on that. There is a different faction of retail that's interested in this as well. Those that were not part of crypto. So they're speculating on this. That's where the NAV premium comes in, which companies can harvest through ATMs and early investors through investing in PIPE. I also have a more like especially for altcoins, I think you'll also see altcoin vehicles come up. There's also argument to be made that there's like, if you see on Twitter, folks like Vana Charmer and folks like them, they'll be uncovering a lot of chart crime that happened in crypto. So there's also kind of a disillusionment with some of the retail folks on crypto side that think they have a better probability of speculating, trading, and making money on these equity markets versus crypto because of their past experiences. And I think the final participant here, which I think it's not that much, but there are a few hedge funds who are taking advantage of like mandate arbitrage. So, for example, if they wanted to go long Bitcoin, they might not have it in their mandate to go do it through ETF. So they would have to express it through either a relative value trade or through some of these stock instrument or through pipe. So it just kind of brings into color different stakeholders that were not involved historically within crypto markets.
100%. And just to follow up on that, like I'm curious, where do you guys think that the NAV multiple ends up long term for these vehicles? I mean, I think like GPTC right now is like within 2% of NAV, like a bank or that obviously has no leverage, like a bank or a BDC or something in leverage or TradFi trade like within 20% of NAV. What do you guys think is the range that you think is reasonable or likely to settle at long term, given like the embedded leverage characteristics of how these vehicles are structured?
Mehdi sent me something on this today that was looking at the correlations to Bitcoin price, like the premium to NAV correlated with Bitcoin price. So, and basically it looked like, Mehdi, that was cyclical, right? So if there's a lot of excitement I mean, take a step back, these are essentially leveraged Bitcoin plays. So if you like Bitcoin here at 107K and you want leverage in a non-liquidatable way, to Mehdi's point, then maybe looking at a new issuance in a pipe makes sense. Maybe looking at just the stock in some cases might make sense if the premium to NAV isn't too high. So it's leverage on your Bitcoin essentially, and the premium to NAV is kind of a function of how excited people are about Bitcoin and how badly they want access to it. I think that's so. I don't know if there's like similar, like with the GPTC trade that you mentioned, Saul. There is an expectation of there was an expectation that it was going to convert to an ETF at certain points, and with that certainty or lack thereof, it traded at a deeper discount or less of a discount to where it kind of, as you pointed out, converged to basically its fees, its NAV minus fees. So that was kind of a isolated trade around that, and then there was some games that Three Arrows and others played where they kind of borrowed short and invested long term. They borrowed short term from Genesis and some of the BlockFi and some of the players that went bankrupt in 2022, and they then took those proceeds that was Bitcoin, from my understanding in many cases, and created shares in this GPTC trade, and then they were locked up for a certain amount of time. That was longer than how their default time to get the money back or the Bitcoin back to the lenders. So that's how that turned into a widowmaker trade for a lot of funds. And this is not, the folks could do that. Folks could figure out a way to borrow Bitcoin, I'm sure, to put into these and have a duration mismatch and go bankrupt. I don't think we're at that part of the cycle yet. And I think there's also credit's just a lot tighter this cycle from using unsecured loans. I think that is very, very rare. Maybe there's definitely lending that's going on from Falcon X and other primes, but they're a lot smarter this cycle on that specific issue. Another thing this is analogous to is you could talk about the SPAC boom in some respects, and some of the either game theory or mechanics around that. But again, there's a lot of differences as well that we can get into.
As Jack alluded, there are a lot of nuances. We do think the NAV premium will suppress if some of the pipe investors come in and get converted or are in the money. But I think the nuance here lies on the fact that all of these MicroStrategy competitors have different business models. So you're also getting that premium on the operating business on top. So, for example, in case of Nakamoto, there's a component where there's a holding company and they have assets there. and those assets are let's say early investments in, for example, Metaplanet and some of the other ones. Then there's a Bitcoin magazine component, which you can also argue should trade at a certain multiple, given they are making revenue from educating people about Bitcoin or arranging these events. And even with Solana MicroStrategy type plays, on top of the accumulation, there's a validator play where you can run the validator and earn yield on it. And in case of the Ethereum one, which was recently announced, you can do both Ethereum staking and then restaking. So another argument is different vehicles will have different NAV premium, and that will be conditional on how market assigns those businesses what value. So automatically there will be some premium. And I think there's that Jack highlighted earlier, there's a macro element to it. So my mental model is, as long as the growth of a protocol is higher than the cost of capital, the premium will last because of compounding. So if we go into an environment, let's say 6 months or 1 year down the road, where interest rates for whatever reasons are lower, these vehicles should in fact trade even at a higher premium because the cost of capital has gone down. So your compounding can happen now at a faster rate for these vehicles.
Yeah, so I think that's a good point to mention, is like the different flavors of both the underlying assets, whether they have cash flows or not, whether they're just holding vehicles or not, and then also like the kind of the different ways that they can finance themselves and also finance the purchases of these assets. Let's talk about 21 Capital specifically real quick. Like, it was you all's largest investment ever, put $40 million into it. So I'm curious, like, what specifically about that deal or the leadership team or the underlying business was that exciting that you wanted to, make it your biggest check of all time?
Yeah, we put out an article on this at the time, an X post, and then we posted on our website at Hypersphere Ventures. Every now and then we feel like we see a fat pitch or something that just makes a lot of sense to invest size into. And CEP was that for us this year so far, because we liked the structure. So it was SPAC, which is a little bit slower to get approved than reverse takeovers or shell transitions, but it's a clean vehicle. So it doesn't have some legacy business. It's just going to be focused on acquiring additional Bitcoin per share, the yield concept we talked about earlier, and bringing in other financial services that are Bitcoin focused, using Strike as partners, Jack Muller as the CEO's firm, as well as Tether, which is the largest shareholder and backer of the vehicle. So we liked those partners. Obviously, Howard Lutnick's firm being the Commerce Secretary, Cantor Fitzgerald taking it public was a nice kind of stamp, made us feel more comfortable on the regulatory side. And SoftBank is the first time that they've ever touched crypto. They're investing close to $1 billion in this vehicle, and for they're like the BlackRock of Japan, and so that's a really big deal as well. And the other investors who came into the pipe were also very high quality and could participate in follow-ons, be it pipes or converts, to continue to get the flywheel going of, a premium to NAV, issuing converts, keeping the premium to NAV, buying more Bitcoin, increasing yield on the Bitcoin per share. So, and then we liked the entry too. So Bitcoin was around 85,000. Tether did a great job of timing that and making sure that the marks were at 85,000 for the initial 3 billion of Bitcoin contributed. And so we liked that level for getting kind of this non-liquidatable leverage at the time into the deal, and we were really excited to back it.
Super cool. I think this strategy is pretty well understood for assets like Bitcoin, right? That have this like hard moneyness, and Bitcoin's kind of in a class of its own, I think, in the crypto space, especially this cycle. But I'm curious how you guys think about this strategy for assets other than Bitcoin, especially kind of like the longer tail of like the top 20 or top 50 assets. So like maybe Sal, starting with you, because I know you guys did XTAL, but then Jack and Mehdi, I'm also curious to hear, like, have you done deals of this type with non-Bitcoin assets? Like, how do you assess those, kind of that kind of thing?
Yeah, I can start with Tao. So we invested in a similar vehicle called XTAO. They're listing on the Canadian Stock Exchange in Toronto, and hope to uplist on NASDAQ soon. I think Tao is a really interesting one because there's the opportunity, Tau is going through this transition as a network whereby the opportunity cost of holding Tau and sort of like the inflation dynamics within the ecosystem are changing massively, and the way that inflation is directed. And so set for the past like 4 or 5 months or a bit longer, people have been able to trade what Bitcenter calls alpha tokens, which are tokens that trade against a zero fee liquidity pool on chain, whereby each one of their subnets has a separate token. And these subnet tokens have programmatic inflation. But the important part to know is that you, as a Tau investor, 6 months ago had 2 options. Basically, you can hold your Tau. There weren't really any custodians that could stake it for you, but if you wanted to do it on your own, you could go and stake it to the single subnet for like 22% yields. Today, there's many options to go and earn yield on your Tau. You can play the game of trading in these subnet tokens and earning yield on the underlying positions and trying to out earn basically the 20% you could earn with Tau. There's also these interesting vehicles that are, you take less, unlike in investing in the DTAU tokens, when you take actual price risk for each one of these tokens, you can go and invest your Tau in something like XTAU and earn yield by the function of harvesting the NAV premium that we've been talking about during this call. And yeah, I think the really interesting things about, these vehicles are not operating businesses by nature, they're financial engineering. And so the interesting thing about them is like how they are financially engineered, and how they're operated. I think it's actually pretty non-trivial to go and get these things listed on exchanges in a fast way, and to operate a TradFi type business while managing the volatility of crypto. And obviously, like for people like whatever Barry Silbert or like Jack Mallers, people who are doing this have made crazy amounts of money off doing it. But it takes a certain type of founder, I think, to be at the helm of it. And so we felt like for XTAU, it was an asset that we held in the form of Tau already in a big position in our fund. We saw a lot of different ways that we could earn yield with a portion of our Tau, but on a risk-adjusted basis, harvesting this NAV premium and doing it with folks we thought were really trusted operators ended up being, for us, the best use of our capital, in a Tau, in a cost of capital denominated in Tau kind of world. We felt it was really asymmetric for a lot of the reasons that Jack mentioned around entry price, around harvesting this premium, around harvesting new sources. Tau is obviously much harder to like hold in custody and access than Bitcoin generally. So, and less liquid. And so you could argue that that there's more of a premium to be had, at least at the beginning, while the space matures. Also more risky, of course, because there's a lot less demand for them as anything once you move down the alts curve.
We also like XTAU. We like Tau in general. So we agreed with all the points Sal made. As we discussed, there are different ways, right? So I'll start with the Bitcoin again. There's another one called Strive. I don't know if you guys have heard of it. So Strive is doing a very innovative way of accumulating Bitcoin. So the way they are thinking about it is, let's do an operating business where you buy assets for cents on a dollar in public markets, private equity type play. Let's say biopharma companies, all of those, and then restructure it and the difference between the realized value versus what it's being traded at. So Vivek, for example, has in his previous life has done few of these things himself, and there's a $30 to $40 billion market opportunity out there in terms of trying to restructure those companies and convert and unlock value. And when you're unlocking value, you can just convert it into Bitcoin or whatever asset. So that's one strategy of doing it. The other one is you can use interesting hedging mechanics where you're kind of selling put options or trying to take advantage of normal distribution or inefficiency in Black-Scholes with your underlining and earning premium on that. So those are like some business model you can apply for Bitcoin. In terms of other altcoins, again, you have a validator business. You can do staking, mining, then you can do restaking. So there could be a operating business on top that could benefit from economies of scale. And because of that, you not only become a treasury accumulation vehicle, there's an operating business on top. So for example, let's take a hypothetical example of Hyperliquid, for example. So with Hyperliquid, the intention would be accumulate hype, and then run the validator, earn some yield, and then stake it and takes a little bit of risk to earn some staking rewards through market making. So you have a operating business on top, and that operating business gets into that economies of scale as the accumulation and as the number of hype you have grows. So that can justify a little bit of premium on top. So there's different business model one can attach to these assets, similar to how we have staking, restaking in crypto. These business model, apart from financial engineering, can be chopped up with different operating angles as well. And separate from the operating angle, given it's we are also entering attention economy, the front person also matters. So there's there could be argument made that there's a premium attached to the front person. So for example, let's say if there's a Solana accumulation vehicle, and for example, Mert is being the front person of that, I would say that should have, yeah, I think there should be a little bit of premium, more premium than let's say some of the other vehicles trading out there, because I know he would be one of those folks that would be able to rally a community as well as an investor base around it, and do interesting things, whether that's on the RPC side or closing business, closing things with government, all of that stuff, right? So I think there are different things to consider and to kind of justify a little bit of NAV premium to these vehicles.
Guys, I want to switch gears a bit about talking from these vehicles. That we were just chatting before recording that we're a very global car right now. We're in Miami, San Juan, London, and Dubai. I think across the four of us. And I wanted to I know you guys have done a bunch of you're obviously based not in the US, and you've done a bunch of investing globally. How do you all think about investing in the two ecosystems, or by geography, or is that a vector you even think about? Like what's it like operating in the venture in different parts of the world?
I think it's good to have exposure in multiple places. Crypto is obviously global. So for these deals we've been talking about to this point, they're pretty much all trading on NASDAQ. I think XTAU might be on the Toronto Stock Exchange, and Sol Strategies, an early Solana acquisition vehicle, I believe, is also in Toronto, listed in Canada. But for the most part, ASST, CEP, Kindly, or now Nakamoto are all, of course, MicroStrategy are all on US exchanges, predominantly the NASDAQ. But on the venture side, there's a lot of activity we see still in the US. I think New York, since Trump has won in November, has definitely grown in the amount of teams moving there. In the Soho area, to some extent, Williamsburg and Brooklyn as well. But that's where we're seeing, I think, a lot of activity. At the very least, people are going there to fundraise, to do meetups, to meet more people. It's like sometimes going to New York is like attending a conference, because there's so many people you can meet there, and it's everyone who lives somewhere else says, wow, this was like way more productive than like 2 weeks, and not to pick on San Juan, but like in San Juan or Bahamas or something like that. So I think for that reason, there's a lot of teams moving there. In London here, there's not a ton of teams, but there's a lot of flow through. People fly through London. There's a bunch of market makers and a couple funds based here. And then I can let Mehdi speak a little bit more about his experience in Dubai.
Yeah, so on the Dubai side, you do have a lot of exchanges, you have a lot of KOLs, you have a lot of market making desks. So you do see alpha, but more of the alpha is oriented towards liquid side rather than venture side. So if you were in Dubai in 2021, 2020, not 2021, 2020, 2023, there were a lot of people talking about SWI and a lot of people talking about TON. So you could have taken that information and implemented in public markets and make good returns. So with Dubai, I would say it's a bit more oriented towards public market. But what we are also seeing is that the amount of good founders are also growing. So we have met many quality teams, even on the venture side in Dubai. And you have a lot of different foundation presence there, like SWI, TON have big presence in Dubai. And for example, Bybit, OKX, they also have offices in Dubai. So you do get these insights. And as Jack was mentioning, as people are traveling between US and Asia, they do transit in Dubai. So you do have the ability to meet different folks.
Definitely. And then Jack, I want to talk a bit about your time at Polkadot, maybe mostly in the context of like the ICO crowd sale meta that I think has really come back these days, especially with the change in like US administration. But maybe first off, on the Polkadot experience, like what lessons or takeaways did you come out of that experience with, in terms of kind of taking a large community from 0 to 1 for like an up and coming protocol?
Yeah, so Polkadot was a project I joined in early 2018 after the ICO in late 2017, and was responsible for a bunch of marketing and business development and fundraising over the 3 years or so I was there. And we launched it in 2020. And at the time, going into that, Polkadot was really the first attempt at having kind of this parachain or subnet or sharded structure. And so it wasn't just a smart contract chain, it was a chain of chains kind of thing. And that would prove difficult because it was complicated. It was novel economics for joining the network, for all these applications joining the network. But we also had a lot of tailwinds. So Gavin Wood is obviously an OG in the space and having co-founded Ethereum. So that helped bring developers and bring attention and bring capital to the project. And so I think there were some things that aren't repeatable like that. There's no other ex CTOs of Ethereum looking to launch a blockchain anymore. All of the co-founders have pretty much done that, right? To some degree. And so that made it easy. That made my job really easy to sell the vision of Polkadot for those years that I was there. But aside from that, I think there is, as Mehdi said, there's a lot of attention now that's required to build a community. It's very competitive as well. It's definitely not a Ethereum, we will build it, they will come. We can just be ideological and we don't need a BD team. Even Ethereum itself has found that over the past year or two that they need to be more commercial, be more buttoned up, more aggressive, however you want to structured, however you want to say it. But that's the more Silicon Valley. I'm not sure, but so it's definitely more competitive now. There's a lot more block space. There's a lot more chains to build on, and you need and so aspects of it of the game, so to speak, of building a community have changed a lot.
Yeah, how do you think, I mean, I know you joined right after maybe, but how do you think the ICO and that kind of strategy of launching played into Polkadot's early success? And then also, like, what do you think about the current meta of community sales and ICOs on platforms like Legion and Echo kind of coming back? Like, would you guys advise portcos to do these when they launch a token, kind of, et cetera?
Yeah, so I think it played a huge success. You look at the non-stablecoin top 15 coins, and like the majority or close to the majority are ICO coins. And I think the advantage launching on an ICO versus, say, an airdrop or some other mechanism is people cherish more what they have to pay for. And kind of the counter argument is, oh, well, they're paying for it by like filling out these forms or joining this Reddit forum or like running a validator. But in reality, those we found are extremely gameable and difficult to measure versus, hey, did you pay money to get in this project or not? So Plasma's running a ICO soon on Echo or Sonar, they're calling it now, kind of an ICO platform. And ICO businesses are very cyclical for this reason, but whenever the market's ebullient like it is right now, it's easier to do ICOs. And I think they're really great. And I think the only reason why they would be less great now is people are like, the teams are throttling how much you can invest, which in theory sounds like a good idea. Like, oh, we want retail, therefore we're going to max you out at like $2,000, but or 10,000 maybe at the upper end. But then you kind of have this situation where you have a bunch of investors who can only put in a couple $1,000s into a bunch of different ICOs. And one of the reasons I got so excited about it is because I had a lot of quote unquote skin in the game for Polkadot to as a contributor to it. And I wouldn't have cared so much had I not had so much, like I wouldn't have been hired because I wouldn't have been in the forum. And I wouldn't have learned everything about the project to be one of the, like I was hired out of the Discord, right? Because I was in there so much, writing blog posts, talking to the community, etc. And I wouldn't have been doing that unless I had more skin in the game than $2,000 or $10,000. So I like the direction people are going in this, but maybe the cat's out of the bag and it's difficult to do the ICOs because if you don't throttle it, you'll have VCs and all these people who come in and take all the ICO. Another rumored one is that's coming up is Pump.fun. The rumor is that they're going to be raising upwards of $1 billion at a multi-billion-dollar valuation.
Wow.
And so that would perhaps give more people access to to the project in a non-throttled way, which I think is good because I'd rather have like 1,000 really, to Chris Dixon or whoever he got that from. Like, I'd rather have 1,000 super fans than like 10,000 or 100,000 people who kind of care.
Makes a lot of sense. Sal, what about you? I mean, I think generally you think it could be a good idea for a portfolio company because it lets them build a community early on and lets them say like, the community got in at the same price as the VCs, which I think is like a really powerful community building narrative to be able to advertise. But I don't know if you guys have done any of your deals or portfolio company deals on one of these platforms. So I'm curious just like, how you think about a kind of a community round or an ICO in the context of building a startup in the US today.
Yeah, I really like the idea. I think like it takes a founder who's super bought in though, because like the adverse selection problem for all these platforms is ultimately at the core of them. And the best deals, the allocations are super, super tight and founders are having to like cut down VCs and investors. And for a founder to say like, hey, I'm going to cut out, $250,000 or $500,000 of my $3 or $5 million seed round so I can like give this to the 50 or 100 different people to contribute at the same price. That I think like the founders who have that instinct should lean into it because it's a really powerful way to align people early. I just think it's we haven't seen like it's not the first thing on a lot of early stage founders' minds when they're trying to design like their product or trying to figure out exactly they may have just pivoted, like they're trying to figure out their fundraise, hire their early employees. It just tends to not be one of the top 5 priorities, and I think that's why we don't see more of it. But I think like what Mega ETH, what other projects like that have done, which is to bring community members alongside very early, is super powerful. And I hope we do have a couple of companies that go down that path, maybe later this year or in the next few years.
And let's change gears a bit and talk about DePIN kind of to close here. So I know we got a bunch of DePIN fans in the room. Maybe Mehdi, we start with you because I know you've done a lot of DePIN investing. Like, what deals have you done and where do you think the sector is headed in terms of like, specifically, I've seen a lot of like these tier 1 customers or partnerships signed. Like I think, Reborn and Unitree, AT&T with XNet and Helium, Grab with Nadix, and Lyft with HiveMapper. So I think there's been a lot of development in terms of like DePIN signing tier 1 customers or partners, but I think we're still waiting to see like an uptick on the revenue side just generally. But yeah, curious kind of your thoughts on the DePIN sector as it stands today and what projects you like or stand out.
Yeah, I think one observation was after the Lyft announcement with HiveMapper, I think we were discussing the other day, the token went down instead of going up.
Yeah.
So I think one problem with DePIN is given crypto is a retail phenomena, I think attention and distribution matters a lot. So one problem DePIN needs to sort out is having access to tier 1 exchanges. So they get the wider distribution in places like Korea, for instance, and also broader awareness in terms of the business model. And I think L1s and some of the gaming and NFT type projects do that really well with KOLs, even though gaming is struggling right now, but at least L1s and middleware, they do have good broader distribution with these KOLs and influencers out there. So I think that's something DePIN projects need to sort out. So 2 investments that I've done, one at Hypersphere and one before. I'll start with the one at Hypersphere was Reborn. It's at the intersection of robotics and crypto. It's one of the newer primitives where we thought, how about leveraging token incentives to kind of collect data to make the R2Sim, which is how you can produce robotics foundation model more accurate by collecting by making the simulation data more accurate. So what it does is similar to Grass, where you're giving token incentives to collect data in different settings, and then basically improving simulation based on that, improving coordination, dexterity. And I think it's a big problem. I think our belief is one of the biggest issues with robotics, more than the intelligence and the hardware is the data. There is a lot of contextual. Unlike it's easier to train AI to make AI write essays, but it's way more difficult for humanoid to hold a cup because of the different dexterity issues that comes with it. So it's a big problem in robotics, and that was our way of expressing it through use of DePIN principle. And I think what the team has done since then is they have partnered up with Unitree, they have partnered with Galbot, and they're making all of these partnerships where they would be upselling the data and helping them produce their like robotics foundation model. So we are very optimistic on how they're kind of tackling the market. There are other players out there as well, but not that focused on humanoid, like folks like Photobot or BitRobots, which are kind of focusing more on rovers rather than humanoid. Similar to the robotics theme, one thing that is interesting in liquid market is GeoNet, which I've been a long-term fan of, where they have been able to create one of the world's largest RTK network, and that allows them to make robotics and self-driving car a bit more accurate in terms of their geolocation, and they have about $4 million revenue using it to buy back tokens. So that was another project on our radar that's interesting and we think is solving a real problem.
Yeah, and then Jack, for you, I mean, maybe you're a bit less focused on DePIN and also focused on other sectors too, but what have you seen recently from DePIN that you think is exciting, and where do you think the industry needs to go to be a bigger blip on the Hypersphere radar in terms of progress or revenue or anything else?
Yeah, I think Mehdi highlighted Reborn. It was one of our early first DePIN-like investments. I think we have invested in some compute networks like Jensen and others in the AI space like Ritual and Sentient. So they're all doing some sort of kind of like distributed compute platform for inference or training and things like that. So those I guess I'd consider kind of early green shoots for DePIN is kind of these AI networks. These similarly, I guess you could argue like file storage was a very early DePIN network, and to some extent LifePeer and these. I think the category just wasn't called DePIN as much back then, but so we have seen some of these in the top 100 coins and build out really robust, really large networks. I think the problem with DePIN, be it storage, be it compute, be it anything so far, demand hasn't been there as much as the supply. So it turns out it's really easy to pay people to spin up nodes. It's a lot harder to provide a service that's cost competitive or has a really good go-to-market. That actually might be the issue now versus kind of Web 2 counterparts. And whenever you're competing with Web 2 or competing with non-crypto only on cost, we tend to not love that. And I think that you could say, okay, it's maybe more censorship resistant, or kind of guards against these edge cases of surveillance and so on and so forth. But the truth is, those are edge cases, and people aren't going to switch just for that. They'd have to switch for cost or some other reason if they're already getting a similar service. So I think we're watching the demand side of these networks really closely.
Yeah, same. I mean, even as someone that's been deeply involved in the industry for a while now, since 2020, I think the question now is go-to-market and sales, really, like business development. Like the networks are built out, there's investor attention, there's tier 1 customers and partnerships that are kind of like lined up and have signed things, but it's just about scaling the kind of sales function for the industry, and I think also for specific DePIN. So guys, with that, we're at time here. I want to thank you very much for coming on. I think it was a great, very wide-ranging interview, but you guys are doing a lot of different things in the crypto space, and so I appreciate you coming on and sharing kind of what's been up.
Yeah, thanks guys. Great having you all on.
Thank you guys. It was great.
Last question, I guess, is if people want to learn more about Hypersphere or reader research or those kinds of things, where would you guys point them to on the internet?
Our X, Hypersphere_, or our website, hypersphere.ventures. And then I'm on Twitter, Jack B. Platts, and Mehdi, you're on our X, and you're on there too.
Yeah, Mehdi Farooq too.
Awesome. All right. Thank you guys.
Appreciate it.